This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our first session on CGT, we saw how it was that we'd establish for an individual taxpayer their taxable gains for the tax year. That started with the individual calculation on an individual disposal of either a gain or a loss. We would then net out the gains and losses of the year to get the net gains of the year. If there were any capital losses brought forward, deduct those before finally deducting our AEA, our annual exempt amount, and that would bring us down to the taxable gain. At the end of the previous session, we then said what the problem was. Having got what is or are the figure of taxable gains, it's then the different CGT rates that apply. Now, that is going to be based on a number of things. Firstly, the type of asset that you're dealing with, and then the level of income that the taxpayer has off their separate, and it will always remain separate, income tax computation, defining whether they are a basic or, as yet, a higher rate taxpayer. Now, in looking now at the rates of CGT and the application of them, what you should do, if you haven't already, is to have open your rates and allowances pages there. And in those rates and allowances pages, find the CGT section. And then you will see the different CGT rates, amongst other things that we are going to be dealing with here. So do, before we go any further, ascertain, please, open up your books and find those rates and allowances page. Again, something which by now, hopefully second nature, you always have next to you whenever we're dealing with any tax area. So, what you'll see on that page of rates and allowances, other than as we've already discussed, the AEA, the annual exempt amount, you'll then see the various rates that apply. We've got a normal rates, we've got rates relevant for residential property, and we've got then rates that are relevant in relation to, well, we don't yet know it, but qualifying business assets, those that rank for entrepreneurs relief. So have that to hand, and let's now go through the notes along with that. As we have said, the various CGT rates that may be applicable are determined by the level of a person's taxable income, and we'll come to that at the bottom of the page. But what it will mean is, other than when dealing with entrepreneurs relief, where a single 10% rate is applicable, other than that, there will be a lower and a higher rate, depending on the level of taxable income that the individual has on their income tax computation of the tax year. So, based on the level of person's tax and taxable income, and then critically the type of asset sold and the availability of entrepreneurs relief. Right, first of all, that last one, assets qualifying for entrepreneurs relief. An entrepreneur, someone in business, disposing therefore of qualifying business assets. That, as we'll discover, is not simply selling off an asset you use in the trade, but selling off a part of the business, a separately identifiable part of the business, or the entire business itself. Now, this relief and all the other CGT reliefs that we need to know, we will find later in Chapter 14. All that we need to know at this stage is if there is a gain that so qualifies, that gain, up to, you'll see a lifetime limit there on your rates and allowances of some £10 million, not usually an issue. Again, it is seldom that for most normal people anyway, they're going to get anywhere near that sort of level of gains. But up to that lifetime limit, we've got a 10%, a single, always there, taxed at 10%, single rate. We've then got separate and higher rates so far as residential property are concerned. Now, residential property, as we mentioned earlier, if it is the house that you live in, your principal private residence, as we have called it, then PPR, principal private residence, relief may apply. Again, Chapter 14. And what that will do in the vast majority of occasions in real life is to exempt effectively all of that gain from being chargeable. The relief will be 100% relief, so there'll be no taxability. But if you've got a separate investment property, or not all of the gain on your PPR so ranks for PPR relief, then we'll be looking at a lower rate of 18% and a higher rate of 28%. So we need to identify what are qualifying business assets for entrepreneurs relief. We look at that in Chapter 14. we need to determine otherwise, is it residential property, not commercial, but residential property, other than that is covered by your own principal private residence relief. Or are we then dealing with any other assets? And the main rates, therefore, that apply to any other assets are a lower rate of 10 and a higher rate of 20%. Now, what we've seen is that in computing taxable gains, as we did at the end of our previous session, that any capital losses and the AEA will be deducted from gains in the following order. Now, we made reference to this right at the end of the previous session. And what we said was that here we are able, and will use the rule to our own best advantage, to make those deductions, be it losses, be it AEA, against those gains that would be taxed at the highest tax rates. Now, they are gains on residential properties, which are taxed at the lower rate of 18 and at a higher rate of 28, as compared to any other assets other than those that qualify for entrepreneurs relief, where the equivalent lower and higher rates are 10% and 20% there. So you would far rather reduce a gain that would be taxed at 18% than one taxed at 10, one taxed at 28 rather than one taxed at 20. And we are able to apply those deductions in the manner that we see fit. It will therefore be in this order. After that, if you've taken out anything that's taxed at a rate above 10%, well, gains on assets qualifying for entrepreneurs relief will always be taxed at 10%. That's the lowest of the possible rates that you can ever see, and that therefore means it's the last of the gains that will enjoy any such deductions. That, as we said, ensures that the deductions from gains are applied first against gains taxable at the highest tax rates. Chargeable gains are taxed at. Now, we've mentioned these lower and higher rates. Lower rate of 10% as compared to 20%. On residential property, 18% as compared to 28%. How do we know where the lower or that higher rate applies? Well, simple. Where they fall within the basic rate band of £32,000 is where the lower rates apply, or the higher rates where they exceed this threshold. The basic rate band, as we know from our income tax computation, would be extended if the person pays personal pension contributions or makes any gift aid donations during the period. So what we need, therefore, is to have reference to the individual's income tax computation. So the taxpayer's taxable income from his or her income tax computation is used as the basis for applying the relevant CGT rates to then his or her figure of taxable gains. Try not to cross that out there. His figure or her figure of taxable gains. After considering the person's taxable income from their income tax computation, so we must reference the computation, the income tax computation, a CGT rate of 10% or 18% is applied on those taxable gains that fall into any remaining basic rate band. Now, you will remember that your basic rate band limit is 32,000, or that could be an extended basic rate band limit if we've got gift aid donations or we've paid personal pension contributions, but at lowest £32,000. If, therefore, an individual has a taxable income off their income tax computation of £30,000, that would mean that there is still £2,000 worth of that basic rate band limit available. So I repeat, if the taxable income was 30,000, basic rate band limit 32, what would that now mean? It would mean that the first £2,000 of your taxable gains will be taxed at the relevant lower rate, and any gains above that 2,000, taxable gains above that 2,000, will be taxed at the relevant higher rate. Which rate is applicable will then depend on the type of property you are dealing with. Are we talking about residential property? Are we talking about other assets there? Or any of the circumstances in terms of qualifying business assets where entrepreneurs relief will apply. That is what we need to know. So reference therefore to the income tax computation. What is the taxable income? Is there any basic rate band remaining? If there's no basic rate band remaining, for example, the taxable income is £40,000, then we're already a higher rate taxpayer, meaning if there are any residential property gains, they'll be at 28%. All of the assets, apart from assets qualifying for entrepreneurs relief, they would then be at any other assets at the higher rate of 18%. So 28 for residential property, other assets 18, and if there is anything qualifying for entrepreneurs relief, it doesn't matter whether you're higher or basic rate taxpayer, it's always 10% so far as you are concerned. So after considering the person's taxable income, CGT rate of 20 or 28, depending on the asset, applied on those gains in excess of that basic rate band, or indeed extended basic rate band. Anything within that basic rate band limit is going to be either 20% there or 18%, sorry, 10% or 18% as the case may be. So 20 or 28, 10 or 18, depending on the type of asset it is. Right, if we just go over, I've done a number of little examples here, such as I was just discussing, but let's have a little look at what we've got. We're told, for example, if the taxpayer had taxable gains of £15,000. Now remember, taxable gains. Be very careful. I make the point after example 1, but we'll talk about it as we go through the various examples. But be very careful about what figure of gains you get. We're referring here to taxable gains. If a question therefore tells you the net gains, how do you get from net gains down to a taxable gain? You therefore would have to deduct the AEA of £11,100 from such figure of net gains to get taxable gains. So when dealing with an objective testing question, please be very, very careful to read very carefully what that information is that they've provided you with. So many mistakes and so many questions I get from students revolve around not actually having carefully read the question. I know we're in such a rush, we're under exam pressure, and we tend to read it too quickly and maybe just miss keywords. Are these net gains or are they taxable gains there? So here it's taxable gains. We have already deducted the AEA, £15,000. We're told that none of these qualify for entrepreneurs relief, therefore the 10% rate, nor are they residential property, so the 28% and 18% rates don't apply. It's going to be the 20 and 10% there. So, what does that tell us? Taxable income of £22,000, basic rate band limit, no reference to any personal pension contributions or gift aid payments made. So we've got, with a taxable income of £22,000, a basic rate band limit of £32,000, that is £10,000 worth of remaining basic rate band. So of our £15,000 taxable gain, the first £10,000 would use up that remaining basic rate band, the 32 minus the 22 there. Basic rate band limit 32, level of taxable income 22, remaining basic rate band 10,000. They, given that it's not residential property, will be taxed at 10%. That will leave 5,000, the remaining 5,000 of the taxable gains, pushed out of the basic and up into the higher rate band. Wherefore these other assets, the vast majority of assets that no doubt we'll have to deal with in an exam question, they will then be taxed at 20%. So the lower rate here is 10, the higher rate is 20%. If the taxable income had been 40,000, as we referenced again a few moments ago, then that would mean that all of the taxable gains would now fall within the higher rate band. With taxable income of 40, you've exceeded the basic rate band limit, you are a higher rate taxpayer. And that means, therefore, that all of your taxable gains will be taxed at the relevant higher rate. As none of the assets are residential property, it will therefore be taxed at 20% there, taxed at 20%. Remember, as we've said in these calculations, you've been given the taxable gains figure, which is after having deducted any capital losses and the AEA. If the taxable gains are 15,000 had been on residential property, then the tax rates, again you've got £10,000 worth of the basic rate band remaining, but your taxable gains would be taxed, would be 18% instead of 10%, and then 28% instead of 20% in the lower and higher rate bands there respectively. I said there to watch out for the language used in the question. That's true about taxable gains. It's also true about the income from the income tax computation. I gave you taxable income. Therefore, we had already deducted the personal allowance. What a question might do is to tell you the net income figure. Now that gives you the net income. You still have to deduct your personal allowance to establish the taxable income. Only then will you know how much of your gains may be within a remaining basic rate band and how many therefore would be pushed into the higher rate band. So watch very carefully for the information they give you about gains and about income. Is it taxable gains or is it net gains? Have we already deducted or do you now need to deduct the AEA? In terms of income, is it taxable income or is it net income? Do you now have to deduct the personal allowance to get you from net income down to the figure of taxable income? Okay, so here, as we've said, remaining basic rate band, for example, go back to that. Taxable gains of 15,000, non-qualifying for entrepreneurs relief, nor being residential property, taxable income 22, £10,000 would therefore be taxed at the lower rate, 5,000 at the higher rate. Taxable income 40,000, we are already a higher rate taxpayer, so it makes it up simple. All taxable gains would fall within the higher rate band and would be taxed at 20%. Again, if it had been residential property, that would be 28%. Remember these calculations, as we've just said, you've been given the taxable gains figure after deducting any capital losses and the AEA. If the taxable gains are 15,000 have been on residential property, as we've just said, the tax rates would be 18% instead of 10, 28 instead of 20. Okay. Have a look back and see what we have identified there in conjunction with, as you've got it, I hope, next to you, your rates and allowances pages. So we need to know, one, how to calculate individual gains and losses, how then to net out the gains and losses to find the net gains, how then to deduct our AEA to establish taxable gains, and then, depending on the type of asset that you're dealing with, and depending on the taxable income of the income tax computation, and whether you are already a higher rate taxpayer or still a basic rate taxpayer, those are the factors that will dictate the particular CGT rates to apply to your taxable gains figure. Right, we've got an example now. Example 1 here. And we've got to calculate Tina's CGT for our tax year 16-17. Right, Tina sold a painting on the 1st of July 16, so the sale date is in our tax year. There's your sale proceeds, £500,000. Again, what you may be also likely to see in an exam question, selling expenses in relation to that sale. They would be deducted directly from the £500,000 to give you net proceeds. We would then deduct any and all other allowable costs. Obviously the purchase cost, £350,000, and for us that's it. So ever so easy here. Your first gain to compute, proceeds £500,000, and your cost £350,000. It is the sale of a painting. So in terms of the tax rates applicable, this is not residential property, it's not qualifying business property there for entrepreneurs relief, so we're talking about either 10% or 20% as the relevant tax rates. The gain, 500 less 350, again very clearly £150,000. She also disposed of a commercial investment property. It's a property, but it's not residential. It's a commercial property, a business property. Sales proceeds, 310,000, again in our tax year, December 16. Incurred agency fees of £15,000 on the disposal. So we've got selling expenses, therefore, to deduct directly from the proceeds of £310,000 to give you net proceeds. Purchased the property, August 98, for £200,000. There's just one figure of cost. Again, watch out for both original cost and any further later enhancement expenditure that may have been incurred. But here's just the one figure. So again, should be a simple answer for you to put together now. I'll talk you through it, you do it. Proceeds, 310,000. Selling expenses, 15,000. 15 from 310 would leave you with net proceeds of 295,000. Away from which we deduct our cost, 200,000. 200 from 295 would leave you with a chargeable gain of £95,000. She also sold an antique vase for £10,000 in January 17. Again, it's in our 16-17 tax year, of course. This time a vase. Look at what's been sold. We had a painting, we had a commercial property there, but it's investment property. This will not rank for entrepreneurs relief. Again, in chapter 14, you will see what there will rank for entrepreneurs relief. So then put that together with the antique vase. Nothing that we're selling during the period is residential property, nor represents assets that would qualify for entrepreneurs relief. So our relevant tax rates, depending on our still to be seen figure of taxable income, would be the normal rates of 10% and or 20%. More of that later. But this sale of the antique vase, look at what happens now. £10,000 proceeds, but the cost £15,000. So that therefore will give rise to a loss of £5,000. Not only does she have a loss this year, but she's got capital losses brought forward from the previous tax years of £12,000. So we're going to have to net out the gains and losses of the year. A gain on the painting there of 150,000, and a gain on the commercial investment property, I think we said, of 95,000. Got to net those out with the loss of 5,000 on the disposal of the vase, and then we'll have the capital losses brought forward to deduct of 12,000. After that, we will deduct AEA, and you will get your figure of taxable gains. Once you've got the figure of taxable gains, we then need to establish the tax rates applicable. Tina's taxable income, 50,000. She is a higher rate taxpayer. Do we have any residential properties? No. So the 28% rate does not apply. Does she have any assets here sold that rank for entrepreneurs relief? No. So the 10% rate does not apply. So the rate applicable, given that she is already a high rate taxpayer, on your normal assets, your normal rate, is 20%. Right. What I'd like you, therefore, now to do is to go through that process if you haven't already. Calculate each of the gains and losses, get the net gains of the year, then deduct the capital losses brought forward, get your net overall gains, from which to deduct the annual exempt amount. That'll bring you down to your taxable gain. What tax rate do we apply? We're a higher rate taxpayer. None of the gains attract entrepreneurs relief. None of them are residential property. So the relevant higher rate is 20%. Right. I'd like you to pause, therefore, here at this particular point in time and actually work through and have a little look at the answer and make sure that you're happy with that. What you'll also find in the answer, doesn't say it here, but I'd also like you to note down when that capital gains tax would be due to be paid. When do we pay our CGT liability? So have a go at that, please, before then rejoining us. Okay, let's have a look through, make sure that you're happy with it. Again, we've talked through all of these calculations. Hopefully you've identified it and agreed it with what you see here. First of all, as we said, we had the painting. We know what we sold it for, we know what the cost was. Again, with that painting, you might have seen, such as you saw here with the investment property, some selling expenses being incurred. But just proceeds, cost, gain 150. With the investment property, we had some selling expenses. What you might also have seen, rather than just original cost, was some improvement, some enhancement, as the expression is, some improvement or enhancement expenditure, which again, as a capital cost, would have been another allowable deduction here in computing the gain. But here, £95,000 worth of gain, from which we deduct the losses of the year. Well, as we know on the antique vase, that was £5,000. So we end up, therefore, with net gains in our year of £240,000, from which we can immediately then deduct the capital losses brought forward. Having deducted the capital losses brought forward, then we can deduct and will deduct our AEA for the tax year, some £11,100. What will that then give us? It gives us, of course, our taxable gains figure. We then have to establish what will be our CGT rate. The statements that we made. Now, of course, if you're doing this exercise, or at least some of this exercise, in an objective testing question, there's no notes. You either get it right or you don't. If you're doing it in section C, then you will explain, of course, the basis of the use of the tax rates. Tina's taxable income of £50,000 exceeds, as we know, the basic rate band of £32,000. Check. Were there any personal pension contributions paid? Were there any gift aid payments made? Did we need to extend that basic rate band limit? Well, no, there weren't, and even if we had have extended it, unless it went above £50,000, it's a higher rate taxpayer that we're dealing with. None of the assets are residential property, nor assets qualifying for entrepreneurs relief, so all of the taxable gains will be taxed at 20%. So 20% of our taxable gains, and that tax figure will be due the following 31st of January, which of course is the 31st of January 2018 there. Now, in this particular exercise, all of the assets that we've had to deal with in the year, the three assets, two of which gave rise to gains and one of which gave rise to a loss, they are all in that category of other assets, i.e. they are not residential property, they are not assets attracting entrepreneurs relief. Therefore, here, as the taxpayer is already a higher rate taxpayer, there is only one CGT rate, that normal asset higher rate of 20% there. But what about if we now, using the same numbers as we see here in this, but there that investment property, if now that had been a residential property. Now, if that had been a residential property rather than investment property there, then that means that we're talking about different tax rates. If we're a higher rate taxpayer, then we're talking 28% tax instead of just 20% tax. So that, therefore, means we now have to segregate our taxable gain figure. We had a taxable gain right down here of £216,900. That would have to be broken up into how much of those taxable gains relate to the residential property and how much relate then to the painting, because a different rate, a higher rate, would apply to the residential property gain. And what we said, if you have gains that will be taxed at different tax rates, then we can apply our deductions, so the losses of the year, the losses brought forward, and then our AEA against those gains that would be taxed at the higher tax rates. That is always going to be residential property as compared to then other assets as finally compared to assets qualifying for entrepreneurs relief. So let's see how we would deal with that. So I've set up here the little working that we would do. Now, all of the numbers that we have already computed are numbers that we see here. So now we run a column for residential property, as we see there, and then a column for any other gains. Residential property gain, as we know, £95,000. The painting is an other asset, other gains 150. The losses we can then deduct from whichever column we choose. Now we will always choose here those gains that would otherwise be taxed at the higher rate. So it will go against residential property before any other assets. Again, I would rather reduce a gain to be taxed at 28% than reduce a gain that would otherwise have been taxed at only 20%. So that gives us our net gains for the year. Again, 9150 rather than the model answer of a moment ago, just the standard 240,000, when it didn't matter as they were all the same type of asset. You could do it all in one, but not now. After net gains, the losses brought forward will then be deducted, again in that order, against your residential property rather than gains on any other assets. Take out your AEA, yet again, targeting those gains, i.e. residential property, that would be taxed at the highest CGT rates. Now, if you wish to, you can keep a total column here going as well, in relation certainly to these taxable gains, and you would see here that that would total £216,900, and you can check that back to your model answer there as regards the question as it stands, our example one. Now that you've got the taxable gains divided between the categories of asset that have the different CGT rates, we can then proceed to tax. The residential property gain, still within of course the higher rate band, is taxed at 28%. And then the other asset gain of 150, obviously we're a higher rate taxpayer, is going to be taxed at 20%. Now it doesn't matter what order you now tax the taxable gains, and whether as here you are already a higher rate taxpayer, or whether you were dealing with someone who still was just a basic rate taxpayer and had some basic rate band remaining. It doesn't matter what order you would tax them in. I would suggest, and as we will always do it, we will tax firstly those residential property gains, then our other gains, and finally, if they exist, gains that qualify for entrepreneurs relief. But it will not matter the order in which you tax the gains. The reason being that we're talking about differentials of 10% in the tax rates that apply either to residential property or then to your commercial property, or to your other assets. So whether it's between 18 and 28 or 10 and 20, the difference is the same. So it won't actually make any difference as to the order in which you proceed to tax the taxable gains here, because the differences between what's in basic and what's in higher rate band, the differences between the two categories of asset is in both cases 10%. What was 18 would be 20, what was 10 would be 20. There's a difference of 10%, so it doesn't make any difference. But here, 66,900 at 28%, 150,000 at 20% would be the basis of computing the tax on those gains. Okay, have a look at what we've done, and then we will return to our notes. And in the light of what I have discussed with you already about on objective testing questions especially, being so very careful to read through the information in the question to interpret it correctly, to make sure that you've recognised the exact term being used, rather than making an assumption about that, have a little read through here what we have said. Again, it's all about, in terms of gains in a question, do they give you the ability to work out the net gain, or do they tell you already what is the taxable gain? If they've given you the net gains, you need to work out the taxable gain, you need to deduct AEA. In terms of reference to the income tax computation, to know whether, where applicable, lower or higher rates are going to be applied, well, there we needed to know, of course, about the level of taxable income. So again, did the question give you the taxable income, such as I did in example 1 there, or does it tell you the net income and you've got to deduct the personal allowance. So be very, very, very careful to read that information and to ensure that you properly understood it. So easy to do most of this right, but just make a silly mistake over interpreting a single piece of information in the question. Okay, we've now got some calculations, some examples for you to practice on between now and next time. Now, in each of these, we're going to calculate the capital gains tax liability for the taxpayer and look at the information firstly given in example 2. Matthew has a trading profit there of 20,000. Trading profit. Not taxable income, trading profit 20,000. To get the taxable income, therefore, you will need to deduct the personal allowance from it. Sold an antique vase, giving rise to a capital gain of 18,000. That's not the taxable gain, that is the chargeable gain. Therefore, you've got an AEA to deduct to work out the taxable gain. So again, look at that information provided. Haven't given you taxable income, haven't given you taxable gains. I've given you the income figure and I've given you the gain figure. You have to work the taxable figures there. Moving on to example 3. Again, here Katie has a trading profit of £41,000 and she's got a commercial investment property gain of 30. So the gain of 30 you need to reduce, of course, by the AEA, and the income of 41,000 you need to reduce by the personal allowance to establish, therefore, how much basic rate band remains. Also, it's a commercial investment property, a commercial, not a residential, so your normal rates again apply. You'll then move on to example 4. Trading profit £45,000, sold a painting £26,000, made a gift aid payment of £2,400. Right. Trading profit £45,000. Now we know we've got a personal allowance of £11,000, so that would bring you down to a taxable income of £34,000. 45 minus 11 would be a taxable income of 34. And ordinarily that would make you already a higher rate taxpayer. But look again, gift aid payment £2,400. Remember, we need to extend the basic rate band limit by the gross amount of any such gift aid payment or personal pension contribution. Remember, therefore, how we got the gross figure. What was the amount paid times 100 over 80. Now, if you extend, therefore, the basic rate band by that figure, you will see, of course, that that takes you back. That figure takes the basic rate band limit above the figure of taxable income. So although you thought we were already a higher rate taxpayer, that is not in fact the case here. So check that out, have a go at example 4. And then finally for you to do at home, well you are at home of course here, but for you to do before you tune in again, Gaynor had a trading profit assessment of 21, so again it's income, no other taxable income. You'll need to take away the personal allowance to get taxable income. Sold 2 assets during the tax year, a residential investment property with a gain of 30 and a diamond ring, so an other asset with a chargeable gain of £8,000. Now their gains, you'll have to deduct the AEA. Think, therefore, which of those assets would you be wishing to reduce the gain of, given the tax rates that will apply? Clearly, your AEA you would wish to put against the gain of £30,000 on the residential investment property, because that is the one that would otherwise be taxed at the higher rates. So make sure, therefore, that you work out there the taxable gains divided in terms of the residential property taxable gain and the diamond ring capital gain. Work out, of course, what is your figure of taxable income and the remaining basic rate band. Then, of course, apply the band firstly to, we would suggest, as we said earlier, and as we showed, the gains that would be taxed at the highest rate. Okay, work those examples through, please. Make sure that you're happy with and you've understood everything in the answers to those examples before we move on again next time. Check those out. As ever, if any parts of those answers that you've had a problem with, you don't understand, then feel free to drop us a line on Ask the Tutor. Otherwise, I look forward to continuing this, as we promised at the beginning, very extensive chapter in relation to capital gains tax. To complete that, well, not complete, but to extend it into our next lecture together. I fear there may be 2 or 3 more lectures indeed in relation to this substantive chapter. Talk to you later.